Good morning, everybody. Uneducated economist here. So everybody's talking about inflation. Donald Trump says there's no inflation. Fed should be dropping interest rates, printing money. Pulled this article coming from the New York Times. The Fed's view on inflation is quietly shifting. Here's why. Now, I highlighted some articles out of here, and I thought I'd read some of them to you here. It goes like this. What we have now is clearly an ambivalent set of circumstances, Mr. Greenspan said at a July policy setting meeting. We are getting a very dramatic acceleration in aggregate demand, but we are not seeing the usual effect in prices. So what he's saying is that the economy is running hot and heavy, but we're not seeing inflation like we would typically see. This is coming from Mr. Powell, Jerome Powell. The reason why we raise interest rates generally is because we see inflation as moving up or in danger of moving up significantly, and we really don't see that now. He said this at Wednesday speaking at a news conference following the Fed's October meeting. He goes on to say this: we would need to see a real significant move up in inflation that is persistent before we would consider raising rates to address inflation concerns. So I think that's funny. Generally, we'd raise interest rates to combat inflation from moving up or in danger of moving up significantly. But he would yet have to see interest rates moving up significantly, persistently, before he would do anything about raising interest rates. Isn't that kind of contradictory a little bit? Anyway, goes on to say like this. We have been below target in round numbers 90% of the time for the past 10 years. This is from Torsten Slock from Deutsche Bank. Now, I thought about that for a second. I highlighted that because I was like, man, where did I hear something similar to that before? Right? So I thought about, okay, we have been below target in round numbers 90% of the time for the past 10 years. Anyway, I highlighted that and thought about that for a minute, and then I continued on. And I found this quote, right? This is from Richard Clarida. And he's a vice chair for, I forget what bank of the Fed. But anyway, it goes on to say, measures of inflation expectations reside at the lower end of the range I consider consistent with price stability. So he even said that, kind of consistent with the previous quote there from that Torsten Slock. We have been below target in round numbers 90% of the time for the past 10 years. So it goes on to say like this: easing policy might lift inflation. And this is coming from Miss George from the Federal Reserve. Easing policy might lift inflation, but at the cost of further tightening an already hot labor market and perhaps fostering financial imbalances. And given the reduced responsiveness of inflation to economic slack, it might take a considerable dose of monetary accommodation to nudge the inflation upward. A considerable dose of monetary accommodation. Well, considering that the Federal Reserve in the last month and a half, 2 months has pretty much undone all the quantitative tightening that had been done since the Janet Yellen started it. They haven't undone all of it, but it's been a huge number of it. That would, to me, be a huge, considerable monetary accommodation to try and help nudge the inflation upward. Anyhow, found this article to be pretty interesting. If you read the whole thing, I'm just pulling the quotes out of it because I thought these quotes were pretty interesting, to another speech that I pulled from the Federal Reserve. But I went back to those two quotes here. We need to see a real significant move up in inflation that is persistent before we would consider raising rates to address inflation concerns. We have been below target in round numbers 90% of the time for the past 10 years. Now, I thought about that for a little bit, and I remembered this speech that we had talked about, the John Williams speech from the Federal Reserve, dated, I think it was November 30th. Anyway, the quote in this one goes like this. Or it's not a quote, this is part of the speech. But anyway, it goes like this. A simple example helps illustrate this problem. Now, he's talking about inflation running persistently low. And so he describes it like this. Say 80% of the time, the lower bound on interest rates does not constrain policy and the central bank aims for the 2% target inflation rate. So basically he's saying right there, say 80% of the time that the Federal Reserve is able to maintain their 2% target. During these good times, an inflation target central bank aims to keep inflation near 2%, but 20% of the time the economy falls into recession that is severe enough that the lower bound constrains policy. Assume that during these periods, inflation averages only 1%. So 80% of the time, inflation averages 2%, and 20% of the time, inflation averages 1%. The resulting average rate of inflation is about 1.8%. As a consequence, inflation expectations are likely to become anchored at the long-run average of 1.8%, below the desired 2% target. So what he is saying there is that as the Federal Reserve attempts to maintain their 2% target inflation, when inflation runs below that, they can't get that inflation up to the 2% because now its long-run average is 1.8%. So he comes up with a couple of options for this. The first option is to maintain the basic framework of inflation targeting and rely on a combination of aggressive conventional and unconventional policy actions when facing economic downturns to limit the deleterious effect of the lower bound. This carries with it the risk that inflation expectations become anchored at too low of a level. So what he is saying is that this first option is probably not too good of an option because it could become anchored at too low of a level. So option number 2 is average inflation targeting, whereby the central bank purposefully aims to achieve an above target inflation rate in good times when the lower bound is not constrained. Properly designed and implemented, such an overshoot can offset the inflation undershoot during bad times, so that the longer run average inflation rate and inflation expectations are in line with the target. Now, doesn't that sound a lot like what Jerome Powell was saying there? We would need to see real significant move up in inflation that is persistent before we would consider raising rates to address inflation. It sounds like option number 2 in here. And he also has an option number 3, which is price level targeting, including various offshoots such as the nominal GDP targeting, and temporary price level targeting. Temporary price level targeting. I love when they use the word temporary. In such a regime, the central bank commits to keep the price level near a steady growing target path. Like average inflation targeting, this strategy promises to overshoot the target inflation rate in good times to make up for inflation undershoot when policy is constrained. So, it sounds to me like we got inflation coming, guys. Not only do we have inflation coming, we're going to have inflation coming. It's going to come hot, and it's going to come for a while. Because they need to make up for the last 10 years of it running at 90%, of their target. So I found that to be very interesting stuff. Uneducated economist. I'll leave links down in the description. You guys let me know.